If you could write a hypothetical scenario of how a central bank could mishandle the economy as badly as feasibly possible, it would be hard to think of a worse than how the Federal Reserve has acted between 2021 and 2022. First off, they kept the rates at all-time lows throughout 2021 while the economy was doing well and real estate prices were skyrocketing. Then they completely misjudged inflation and then jacked rates up faster than any time in history to quell the inflation that they didn't anticipate. Now, this has created a massive glut of unrealized bank losses and other economic discombobulations, i.e. the recent 4 bank failures that we've seen. The goal of any central bank should be to maintain stability, and it's hard to see how they could have failed to keep things stable, more so than they have over the past few years. Now, due to their own incompetence, they are facing a horrible catch-22 right now. Even before these recent bank failures, the Fed had signaled that they would slow down their rate hikes. Now they may be rethinking the entire policy in that regard. As I've noticed in other articles, all other things being equal, the more money that's injected into the economy, the more inflation there will be. And what's happening with the bank failures is just going to cause more inflation. This is one reason that increasing interest rates tends to lower inflation. It reduces economic activity and the number of bank loans necessary. And because of fractional reserve banking, bank loans add money to the economy, whereas paying them off or loans going delinquent removes money from the economy. See here for a more detailed explanation. Now, unlike TARP from 2008, Silicon Valley Bank and Signature Bank were not bailed out. But the depositors were entirely bailed out despite FDIC insurance ostensibly capping deposit insurance at $250,000. A lot of businesses would have been unable to make payroll had the FDIC not done this. Whether it's acceptable to make the rest of us pay for their deposits is another question. But what's clear is doing so injected a lot of money in the economy. JP Morgan expects the Fed's emergency actions to have added $2 trillion to the banking system. Now, in the middle of last year, I predicted inflation would be with us for quite some time. In part, it was because I did not believe that the Fed had the courage to raise rates enough to break inflation, as it would likely throw the economy into a recession. Now, I've been surprised to see how aggressive they've been, for sure. But in doing so, they've inevitably created major problems that the collapse of Silicon Valley Bank, Signature Bank, and the buyout of Credit Suisse, not to mention the huge amount of unrealized HTM losses that make it just that point crystal clear. Now, if they keep increasing rates, those unrealized losses will increase proportionally, and more banks will likely fail. If they don't, any progress thus far on fighting inflation will stall and likely reverse, and high inflation will probably be with us for the foreseeable future. Now, the Fed's already blinked once by bailing out the depositors. Will they blink further by halting their rate increases, or will they actually lower them? We just had another quarter-point increase, so we shall see. Either way, we've been backed into a corner of our own making at this point. And the economy will suffer one way or another, that's for sure. Investors should not expect a 2000-style collapse, but in my humble opinion, that absolutely should expect to see continued volatility and a protracted economic malaise. Now, if you're in need of an experienced commercial real estate broker, I'm glad to be of service, and you can reach me at 281-222-0433. Thanks for your time, and have a good day.